Let us discuss about fiscal policy. According to Arthur Smithies, fiscal policy is a policy under which the government uses its expenditure and revenue programs to produce desirable effects and avoid undesirable effects on the national income, production and employment. Fiscal policy in short refers to the budgetary policy. It was Keynes who popularized the interest in fiscal policy as a measure attaining macroeconomic goals like increasing the level of employment and income in an economy. Prior to Keynes, the classical economists believed in the principle of sound finance, in which small and balanced budget was considered to be the ideal one. Keynes for the first time stressed the need of state intervention in the economic field and advocated for an unbalanced budget. Following Keynes, A.P. Lerner gave the concept of functional finance to modern budgetary policy. To quote Lerner, the principle of judging fiscal measures by the way they work or function in the economy we may call functional finance. Let us go to the history of fiscal policy. The use of fiscal policy to attain and maintain full employment and a stable price level is largely a development of the past 55 years or so. This use of fiscal policy began during the 1930s largely as a result of three developments. The first was the apparent ineffectiveness of monetary policy as a means of solving the severe unemployment of the Great Depression. The second one, the new economics advanced by Keynes with its emphasis on aggregate demand and the growing importance of government spending and taxation in relation to the economy's total income and output. From a relatively modest beginning, fiscal policy has grown to become the major means by which public policy attempts to achieve full employment and to prevent inflation. In tune with the classical laissez-faire capitalism, balanced budget under the principle of sound finance was considered as a sole budgetary goal. That government is the best which governs the least was the popular slogan. The limited scope of fiscal policy in earlier days was automatically related to the notion about the functions of the state. In the words of Professor Hansen, the classical concept of sound fiscal policy corresponds to the maximum of a neutral fiscal policy, and it is called for two things. The first one is the reduction of public expenditure to the almost possible limit. That is, the public expenditure should be the minimum. And the second one is a tax structure which leaves the product and prices undisturbed. Therefore, in the earlier period, the importance of fiscal policy is not that much highlighted than what is followed in the modern times. The concept of fiscal policy, however, received a new vista with the inception of new economics, that is Keynesian economics in modern times. Keynesian theory shattered the basic foundation of the classical doctrine when the former asserted that the competitive forces of free enterprises economy does not necessarily ensure an effective demand such as to absorb all productive resources at full employment. Supply does not create its own demand and the economy may attain equilibrium at an underemployment level. In modern times, the term fiscal policy that become very complicated and very elaborate. It embraces the tax and expenditure policies of the government. This fiscal policy operates through the control of government expenditure and tax receipts. It encompasses two separate but related decisions related to public expenditure and the level and the structure of taxes. The amount of public outlay, the incidence and the effect of taxation, and the relation between expenditure and revenue exert a significant impact upon the free enterprises economy. Broadly speaking, the taxation policy of the government relates to the program of curbing private spending. Expenditure policy, on the other hand, deals with the channels by which government resources are pumped into the private economy. Government spending on new goods and services directly adds to the aggregate demand and indirectly increases income through secondary spending, which takes place on account of the multiplier effect. Taxation, on the other hand, operates in reducing the level of private spending on both consumption and investment by reducing the disposable income and the resulting savings in the community. Hence, under the budgetary phenomenon, public expenditure and revenue can be combined in various ways to achieve a desired stimulating and deflationary effect on the aggregate demand. Fiscal policy, thus we can say that has a quantitative as well as qualitative aspect. Changes in tax rates and structure of taxation and its incidence influence the volume and the direction of private spending in the economy. Similarly, changes in government's expenditure and its structure of allocation will also have quantitative and redistributive effects on the income, consumption, and aggregate demand of the community. As a matter of fact, all government spending is an inducement to increase the aggregate demand both in volume and in component, and has an inflationary bias in the sense that it releases funds for the private economy which are then available for use in the course of trade and business. Similarly, a reduction in government spending has a deflationary bias and it reduces the aggregate demand, its volume, and the relative component in which the expenditure is curtailed. Thus, the composition of public expenditure and the composition of public revenue not only help to mold the economic structure of the country but may also be expected to exert certain effects on the economy at certain times and a quite different impacts on other times. Okay, let us conclude that the modern fiscal policy is also known as the positive fiscal economy. It is a process of framing the taxation and expenditure program of the government to achieve higher growth rate and to do away with the evils of inflation and deflation. Modern fiscal policy is nothing but the application of the functional finance. Thank you.